Bill, good morning. Good to see you again.
Good morning, Carl. Thanks for having me.
How are you thinking about the current environment? Is the market coming to you as a value investor? And when you see a number like existing and that annual rate, is that doing the kind of work that you think the Fed wants to see happen?
Well, yes, the market is coming to us, and we think there are a lot of very cheap stocks out there right now. But unfortunately, investors tend not to get as excited about adding to their portfolios when the market is down. So we aren't being flooded with new money to take advantage of these opportunities. We always encourage investors to revisit their asset allocations and consider rebalancing portfolios. If you haven't touched your portfolio since last fall, cash is a much bigger percentage of that portfolio today than it was then. And we think it could be a good opportunity for people to put more capital to work.
When you talk about there being a lot of cheap names, I know you've long watched financials, energy, autos, and trucks. How are you balancing? First of all, what names are you talking about? And are you worried about earnings estimates coming down even after valuations have come down?
Well, I would say in those sectors, we like most of the names. Our largest financial holding is Ally Financial. The stock sells for just under $40 a share. They're supposed to make about $8 a share this year. They pay a dividend that's higher than the 30-year bond yield. And they're also repurchasing, at current prices, it would be about 17% of their share base this year. So even if the top line doesn't grow at all, earnings per share would be growing close to 20%. In the energy area, most of the stocks are also single-digit PE multiples. Our favorites would include EOG, Apache, Conoco. Those companies are also returning a lot of capital to shareholders, especially under pressure from ESG investors to not fully reinvest that capital. A company like GM sells at about 6 times earnings, and you can find similarly attractive names like Borg-Warner or PACCAR. It seems like if it has a motor and it moves, the stock price is a single-digit PE. Those companies are also putting excess capital that they're generating to good use today. So,
Bill,
I would
David,
say,
if I could just stop you there. Yeah, hey.
Of course.
I mean, I've heard a lot of we've talked obviously through bull and bear markets. I've heard a number of those names in your portfolio for some time. I'm curious, anything new, anything that you were watching that has fallen to a level that now suddenly is an opportunity for you to be buying, as opposed to something that perhaps you've simply added to or has been in your portfolio for years already?
Well, there are a couple new names in the past quarter. Pulte Homes was one of those names. It's a company that's supposed to earn something like $11 a share this year. The stock price is just over 40. Pinterest is a name that we purchased just going into COVID after the stock price had fallen dramatically. We sold it, in hindsight, way early, but it's retraced almost all of those gains despite the business performing as well as we had hoped it would. And on a price per monthly user, we think Pinterest is one of the cheapest social media names. And you're right, David, we've been through a lot of this over the years together. Oakmark started in 1991. This is the 6th bear market that Oakmark has been through. We aren't market timers at all. It's a skill set we don't have. We don't think many people do. But over that 30-year plus period, the S&P's up over 20-fold. And by buying out-of-favor stocks when nobody else wants them, we've been able to do almost twice what the S&P has. So we don't think this is at all a time for panic.